So today we're going to talk about which real estate domino will fall first. As you can see from the slides here, I broke real estate into 3 categories. And a lot of times when you're watching the news or you're talking to people, they lump real estate into one big category. But you and I both know that real estate can be broken in multiple categories. We're going to start with land, commercial, and single family. So the majority of the news is centered around single family. And of course, we hear about the interest rates and the prices dropping, prices rising, all of those kinds of things. What's important to know here that all 3 of these are very connected in many, many ways, primarily through debt and equity, as many people invest in all 3 categories, and each category has an independent behavior on its own. When you're watching something on the news or reading something, it's typically primarily around single family real estate. And I just want you to understand that that's a very, very small percentage when you look at real estate as a whole. So as you can see, as you're looking at land, commercial, and single family, you need to consider the markets that they're in, the type of real estate, the demand and supply of each individual market, interest rates, migration patterns, which we're going to talk a lot about, work from home, government policy, cost of living, weather, and crime. Now, of course, there are more, but these are very big ones that can be the difference on whether somebody moves somewhere or moves away from something. These items right here can be the difference on whether somebody buys land, moves into a commercial building or out of one, or even buys a single family home in a particular area. And as all of these items are tracking very differently, each one of these categories also react very differently. So for today's video, we're going to focus on commercial because I believe that this is the first domino that's going to fall, specifically commercial office. Stick around. We're going to get into more detail about that soon. As you can see, as you dig a little deeper on the commercial side, there's office, industrial, retail, medical, multifamily, self-storage, mall, and there's even more than that actually. What's important to understand under the commercial umbrella is that all of these types of assets react differently based on every single one of these categories all the way to the right of the slide. So now that we've got that out of the way, I want to talk about herd mentality. So a lot of you know that I went through the 2006, 7, and 8 debacle, which was one of the largest real estate crashes in the history of the United States. There are a lot of lessons that you can learn when things are crashing, and you don't learn a lot of lessons when things are rising. So the definition of the herd mentality is when you're influenced by the majority, when you conform with others in a group as opposed to thinking individually. So as we go into these very uncertain times with high inflation and high interest rates and all kinds of other things that are very big red flags, I want you to consider what you're doing and how you're investing and be an individual as opposed to be conforming with a group or a herd mentality. So on this first slide of a herd mentality, you can see the different kinds of cycles in red. Now those are traditional bell curves. We've all seen those. As you probably should know is that real estate does have highs and does have lows, just like pretty much everything. The green words represents people's emotions of how they're feeling at different points in the real estate cycle. As you guys know, I did a video on procession of exactly how I thought things were going to roll out at that point. At this point, in March of 2020 was when they officially declared the pandemic, they officially declared a recession, and inflation was sitting at 1.23%. The federal funds rate was 0, and the price of a single-family home, $374,000. That meant in March of 2020, you could buy a $374,000 home with a very low interest rate and move into it very affordably. So let's forward 1 year to March of 2021, where now the average inflation for that year is 7%. As a result of all the stimulus money that was given to the people and, of course, to the PPP loans for the businesses themselves. What's important to note here is that the federal funds rate was still 0, and the single-family homes had gone up from 374 to 418 on the average. Now let's go 1 more year. So March of 2022, just 1 year later, all that stimulus money has now made it into the economy. People's savings rates were high, and they were consuming and spending lots of money, which continue to drive inflation up. At one point in 2022, we peaked with inflation at 9.1, As you can see from the average, it settled out around 6.5%. So as you can see, in just a period of 2 years, homes went up about $150,000 on the average, and the federal fund now started to go to work by raising the federal funds rate. So now let's look at March of 2023. As you can see, this is our third year, and the Fed is now starting to really react. They increased the federal funds rate another 8 times from 2.5 up to over 5%, which creates all kinds of chaos in the real estate industry. So when interest rates go up, the entire commercial market changes as well. The difference is most of the commercial buildings are being acquired by professional money. So for today, I'm going to focus on what I consider to be the first domino to fall. If you take a look what has happened to the office market, specifically from the work from home, and you understand also that most of these leases are 3, 5, 7, even 10-year leases, as those leases start to renew, they're downsizing or just eliminating their offices altogether. So office buildings will be the first domino to fall because many of those people do not want to come back to work. The vacancies in those buildings are much, much higher, and the landlords are barely able to service both the expenses and the debt. So as we always talk about on the Ken McElroy channel, is you got income, expense, debt, and cash flow. When income is down, it barely covers the expenses and barely covers the cash flow, if at all, and therefore these office buildings are going to have severe cash flow needs. The second thing are the interest rates, which we've been talking a lot about. So imagine if you bought this office building 3 years ago or 4 years ago and it was full of tenants. And today, a lot of those same tenants' employees now want to work from home, and your loan is coming due. And this is the biggest issue, because 3 years ago, you probably have a loan of somewhere around, let's say, 3%. But today, that same loan on that same building with those same tenants are closer to 6%. As the office building's occupancy and income continue to decline, also their expenses are rising as well. Property taxes are up, insurance is up, utilities are up, all those kinds of things are up. So that's a recipe for a lower net operating income or a lower NOI, as we talk a lot about in our videos. So now these office buildings are facing a double whammy. One, they have a lower net operating income from lower income and higher expenses. And two, they have higher interest rates on the existing loans, or if they're trying to refinance something, let's say their loan's due, they're not going to be able to refinance it because the actual property that they bought is actually worth less than the loan. So in a lot of office building owners, we're going to have what's called a debt crisis. Just like the United States is in a debt crisis, and just like the normal American, in many cases, is also in a debt crisis. So here's a couple things to consider. The vacancy rates in a lot of these office buildings, specifically in Manhattan, Silicon Valley, and Atlanta, are hovering around 20%. I've heard in San Francisco, it's even higher. What's important to understand is that this is a record high. Never have we seen these kind of vacancy rates before in commercial office. The next piece should be alarming to you. Developers might default on a big chunk of the $3.1 trillion in commercial real estate loans that Goldman Sachs says are outstanding. Almost a quarter of that number needs to refinance in 2023. So as you can see, the commercial real estate faces a brutal combo of higher rates, tighter lending, and looming debt, and the fallout could be disastrous. And what's important to understand here is somebody holds this paper. There's debt and there's equity. On buildings like this throughout every city in the United States, there's both debt and there's equity. So how does this affect you? Because a lot of this paper and a lot of this debt is held in a lot of these regional banks. This commercial debt and this commercial equity is a big deal, but only because they have to actually refinance in 2023 or 2024. Otherwise, it's just a normal property with the equity going up and down based on the interest rates at the time. The reason I'm doing this video, because these banks are actually pulling back on their underwriting. They're pulling back on the loans that they're going to do because they already know this stuff. So this is going to be the first domino to fall. And what's going to happen is this commercial paper is going to hit your local, regional, and big banks, and they're going to pull back on their underwriting and their loans that they're going to be giving you for more consumption in whatever it is that you're going to do, further slowing the economy even more than it already is, and potentially tipping us all into now what could be finally called a recession.